Well, hello everyone, and welcome to another Southern California housing market update. My name is Stephen Meade with Domicile Real Estate. We are a real estate brokerage here in Southern California, Los Angeles and LA counties, and we are on a mission to help California's renters become homeowners. And so I wanted to go over our whole market update today. And a lot of things have been happening, and you might have heard the term bond market thrown around a lot and wonder exactly what that means. Basically, that is sort of the financial market, like the stock market, that really determines mortgage rates. And it has been incredibly volatile. So I want to give you a caveat. We're going to display some numbers here that are Freddie Mac's weekly mortgage tracker, but the bond market actually rallied in the last 2 days, and the rates are better than that. So let's get right into it. Kind of a lot to discuss and unpack this time. So here we go. Alrighty. So let's start off with total active listings. And, this might look like great news to you if you're a seller. Oh, look, the total active listings have stopped going up. But the reality is by this time last year, we were starting to see kind of our fall downward trend. And we're seeing that a teeny bit, but not really. Those numbers are just kind of holding. We're kind of just seeing the number of listings on the market. And again, the blue line is under $1 million. The red line is $1 to $2 million. We're just kind of seeing these numbers holding there and not really changing a huge amount. In fact, we got a slight uptick here on our 1 to 2 million and pretty flat here for our under 1 million. Moving on, if we look at our new listings, right, coming into the market, we see that we are off those summertime peaks. And in fact, here in our under 1 million category, I mean, really, this number is really just dropping down. We're quite a bit lower than where we were last year, and the reality is kind of around where we would really be sort of towards the beginning of December. So it's almost like we're a month ahead of time on schedule. Our 1 to 2 million, we're trending right about where we were at this point last year, but even that is kind of off those kind of summertime peaks. I mean, what we're really seeing here is that sellers are reticent and reluctant to put their homes on the market. And it makes a lot of sense when you think about it. Number one, they might not necessarily like the pricing that they're seeing, or they might not like the fact that, they're going to have to prepare their home for sale. Two, we are heading into the time of year that sellers are less likely to want to move, right? Because imagine, even if you put your home on the market today, that means, and it's sold immediately, you wouldn't be closing for a month. That puts you really right around Thanksgiving timeframe. That is not really a desirable time to move for a lot of people. And then finally, probably the biggest reason is if you are a seller, you've most likely refinanced your home and you have a loan that is around 3%, maybe even under 3%. Why would you want to move and sell that home and trade that for a mortgage that is significantly higher? I think that you have to have a special compelling reason, like a job move, to do that. And so we're just not seeing consumers really putting their homes on the market at the same rate. This is our kind of supply side of the equation, right? Now, if we go and we look at the demand side of the equation, something kind of interesting has happened, right? We see that, these have been steadily falling. They kind of picked back up, right, when rates stabilized out, and they've been dropping further, and they've kind of leveled out as well since 2 weeks ago. So we're seeing the new escrows level out. I'm always curious to see how the different, how the interest rates really affect this. One of the problems is that this indication is always delayed a little bit, right? Because most people follow the interest rates and then they look for a house. And then by the time their offer is accepted, time has passed since then, right? And the rates might have moved. So I'm kind of curious to see that. We do see this number way down. But again, these are not terribly unstable numbers, right? And in fact, we're actually heading straight across here in both our under 1 million and our $1 to $2 million categories. If we go here again, one of the things that we have here is looking at our absorption rate. And really, this is a quick and dirty sort of what kind of balance do we have for supply and demand? Now, interesting, we're right about 70% for our under 1 million category. That actually is not terrible. So I got a question today, and I'm gonna go off screen share here. I got a question today where somebody asked, if interest rates are going up, why is it that home prices are just not moving a huge amount, right? Like we've seen them come off those sort of like April peaks, but the reality is, I think a lot of people were sort of expecting some kind of a crash in it, and it just hasn't materialized. And they said, how does it make sense that you know demand can essentially go down, but pricing remains unchanged? And I said, well, you're forgetting the other half of this. They call it supply and demand, right? Like there's the other side. There's demand is one part and supply is the other. And it's the balance between those two really that affects pricing. It's not either of those variables by themselves. And that's really what we're seeing here. Though the question is, if we've gotten to a point where any of the sellers who don't need to sell aren't selling, right? Supply is reduced as much as it can. What happens if demand erodes further? Is that going to finally get something for pricing? And honestly, I don't really know, because everyone's talking about, do we think rates are going to go up further, and where are they going to peak before they kind of crest, like the Mississippi River during a flood? What's going to be the high watermark, as it were? So on our absorption rate, we do see kind of a pattern, and this really sort of just reminds you of kind of the story of our market, right? If you look over time, we were flying, pretty high here through about April, and then as rates went up, these absorption rates started to go down. Then it started to bounce back up again. So the point we're at is actually not really near the lows, right? The low point was during that June, early July period. We're actually in a better state than that you can see this 1 to 2 million category is definitely falling a little bit faster. Now, moving on, if we look at our closed prices, and again, I say this every single time, it is just as important every time. This is a trailing indicator. It means it is taking a look at what was, not necessarily what is. And if we look at that, we see upticks in both our 75th percentile for closed prices, our median, and flat on our entry level, right? And remember, there is a good amount of sort of variance from week to week in these variables. We see them kind of go like this. Our sample size is pretty big, but not big enough to make these look completely smooth. So, bear in mind that this is looking a window into the market more or less 4 to 6 weeks ago, and that there's some definite variance week to week. If we look at our still active after 14 days, that number rose up, indicating less competitiveness, and then it's kind of really hovered, maybe coming up a little bit in this latest round of rate increases, but really these numbers are not coming up in a huge way like we might have expected. If we look at our close to list ratio, this is kind of an interesting one to me, right? Only because if we look at our history, where were we a year ago today? Well, a year ago today, on average, the average home, both under a million and 1 to 2 million, the average home was selling for about 102.5% of list price. Meaning on average, they were 2 to 3% over list price. And we saw those numbers super strong throughout the spring. In fact, even peaking up here. I mean, look at this. Look at this in April, right? 105% for under a million and like 107% for 1 to 2 million, right? And then things kind of crested and they really started easing, and then they fell quick. And now they've kind of leveled out down here right above 99%. That is kind of a long-term historical average for us, by the way, in our market here in Southern California. Generally speaking, this number is between 98 and 100% most of the time. It is exceptional when this number is outside of that range. So here we are hitting right in the range that we might expect. Now, looking at our days on market, this is something we've really seen kind of climb up. This 1 to 2 million is now hitting 40 days, though we've kind of leveled off here for our entry level under $1 million market and the high 30s. These are pretty normal numbers, folks, like in the long run. Where were we last year? Well, last year around this time, we were in the, around in the mid 20s. So not a huge drastic difference. In fact, these are still better than our long-term average numbers. Our long-term average numbers are usually 40 to 50 days. So, I think it's healthy to have a sense of perspective in this market. If you're a buyer or a seller, and understand that while this market is very different than something you've seen in maybe the last 24 to 30 months, this is really not that different than how the market is kind of in the long run over time. And then we have the three-way, right? And the three-way is an area that I actually have some concerns that I wanted to talk you through. And so one of the things that you notice if you look at this graph, and again, just as a reminder, this blue line is our payment index. And this is a payment on a median priced home indexed back to June 2018. The red line is our CPI index, again, back to 2018, June. And then the yellow is our rent index on a single family home in LA and Orange counties. And so what this graph does is by indexing these back to June 2018, we basically started them off all at the same point, and I said, how have these numbers changed relative to one another? So that's why we have percentages on this graph, and we don't have absolute numbers. And so if you look at this number, I mean, really all through 2021, a good part, and heading into 2022, these actually had all grown fairly similarly since 2018. But then in the spring, things started to change. And we saw this payment index rise up rather dramatically. And we got this big gap here, right? Where the payment index had changed quite a bit versus the rent index. And this differential really is an area of concern. And the reason this is an area of concern is because this means that markets are out of sync. Now, if you look here, something interesting happened though, and that was that rent actually climbed and closed this gap, and it climbed rather dramatically. And so one of the things that I think we've noticed in this market is that the rents tend to lag the payments. So if something happens with payments, the rental market lags. And this makes a lot of intuitive sense when you think about it. People who are buyers and shift to being renters, if they were going to write an offer on a house and now they've decided to be a rental, like there's a delay in this process while people figure things out. So we might say that the rental market trails the buying market right now. And so you see things really started accelerating, and we were probably about a month or so out, right? And what we've seen here is payments actually dipped down, then we saw rents dip down, and then payments started heading for the moon, and rents are still here. And what I'm curious to see in this chart is in 2 weeks when we review this again, is are we going to see the rents rising up to meet this payment index? Now, with a little bit of warning, something I said at the beginning of this, we take our mortgage data for calculating this payment index from Freddie Mac's weekly mortgage index. The market last week for mortgages was not good, and it basically peaked at a big number, and has actually since come off of those peaks. So in reality, this number is probably closer to down here. But yeah, I want to see how this rental market reacts. So we truly hit an affordability ceiling, which is something that people are talking about, or are we just seeing a delay in that rental market and it has not reacted to where housing payments have gone just yet? And there is now an influx of renters coming into this rental market, competing over the same number of rental homes available. Is that going to make a difference? Finally, we have our prevailing mortgage rates. Again, this is based on Freddie Mac's national index for 30-year fixed. That is not always an entirely, pertinent number, maybe for buyers, especially right now, but we like the consistency over time. This is just under 7%, but like I said, the last couple of days have been a bit of a bond market rally, and I think we are more towards the middle sixes at this point on the interest rates. Now, the real question all of you are asking is, when do I think rates will drop back below 6%? And if I had the answer to that question on mortgage rates, I probably wouldn't be doing videos on YouTube. But with that said, I think it's going to take a little while before that happens. And the reason being is you have to understand why rates are where they are. And it's because there is a lot of uncertainty about the future of inflation. And Right now, that future is incredibly uncertain. And so there's a lot of risk-based pricing involved. Remember, a 30-year fixed rate mortgage on average is held for 10 years nationally. And so you've got a situation where mortgage lenders and bond buyers are trying to figure out, where do they think this is going to be in 10 years? And they don't know. And I think until there's some certainty and maybe even clarity is a better word here on sort of the future of inflation and is it under control? Is the Fed going back to a 2%? I think until that happens, you're not going to see relief on these mortgage rates. There needs to be some clarity about the future of inflation in order for that to happen. Anyhow, thank you so much for watching. Questions, comments, we love them. Don't forget to like, subscribe, and hit that notification bell. And once again, if you are looking to buy or sell a home here in Southern California, Los Angeles and Orange counties, we would absolutely love to help you. If you are a first-time home buyer, we would really love to help you. And if you're an architectural lover, we are always down for chatting because we love houses. We'll see you again real soon.